So welcome, Radio Pride listeners. Thanks for joining me as always. So on today's episode, it's recording this at the heart of tax season. We're in March here, and it's getting a little hairy. As you can imagine, we're trying to get their tax documents together. You may be doing this as well, and all your tax professionals working so hard to just kind of accurately report and file. And so it's a lot of chaos, obviously, this time of year. And so it's one of those areas now, that there's a compliance arm to it. However, this is really a potentially really good time thinking about tax planning, right? Because you may not have maybe done anything about it in last year or prior years. And now you're gathering your information. You see, wow, this tax bill seems to get worse and worse every single year, and I haven't done anything about it. And unfortunately, your tax professionals who are helping you maybe file are just way too busy, too focused on sort of filing and haven't been able to help plan. And so that's unfortunate. That may be the case. So this could be a good time. But today I really want to cover what tax planning could look like, right? But this is off the heels of the IRS recently releasing their Dirty Dozen list, which, it lists the most common tax scams and abusive schemes that they're seeing across the country. And so that's not tax planning, that's cheating, and sometimes just simply fraud. And it's things that certainly we would never support, nor should we. And, it's good for us to all be aware of them because not all of them are easily identifiable, but it's good for everyone to be on the lookout for them because, they could impact you without you knowing that they're fraud. They could be marketed to you as sort of advanced tax strategies or these secret loopholes to help you eliminate taxes. And sometimes they're just difficult to know if they're real. And obviously, tax planning is good, but getting into some of these fraudulent strategies or approaches are going to obviously put you in harm's way and potentially lead to audits and a lot of other pain. So today I want to kind of just walk you through some of the elements of some of the ideas within the Dirty Dozen, just so you're aware of them. And you can look at them online. There's a list on the IRS. They make these things known every single year to make the public aware of what is going on, what they're seeing, and then talk about and transition to a more positive approach to good tax planning. What does that look like? What you should be thinking about versus maybe opting for potentially some of these more dangerous shortcuts and loopholes as they are described. So what really is a Dirty Dozen? So they could be targeting anyone from individual taxpayers to business owners to high income professional, you name it. And sometimes even tax professionals themselves they may be targeting. So again, we're not saying tax planning is bad. There's great things around to encourage investing in certain areas or business ownership or charitable giving or saving for retirement. But the Dirty Dozen really takes it too far and in a lot of ways illegal, and they're created. So some examples, just to give you a sense of what these are or can be. And one is trying to impersonate the IRS. Now, at this given time now, you may have heard of there's just fewer people working for the IRS. They had to eliminate a lot of the jobs. So they're working with a lower reduced resource bandwidth. And so there are a lot of scams that are coming out now where the IRS is supposedly the IRS sending emails or text or calling you, automated phone calls, and saying, hey, we've loaded a red flag on your account, or your refund is ready, or your account has been flagged, whatever things that are going to draw your attention, or you have taxes you owe, and you have penalties that are going to start piling up. And really the goal around a lot of these things are phishing. They're trying to get information, right? They want to get your sensitive information around your Social Security or your bank information or credentials that will log into your IRS account, whatever the case. Or they want to just try to fish for information so they can go act as if they were you and cause some damage. And so one thing just to know that IRS will never call you or email you to start. They're going to send a physical letter to kick things off. And so without that, then, you can almost immediately discount them as fraud and don't do anything about it, right? So you're going to get an email. You're not going to get an email. You're going to get a physical letter, official letter from the IRS if there's an issue that they need you to pay attention and do something about. So all those other ones, calls, emails, whatever, they're going to not be real, and you have to just be mindful of them. And unfortunately, a lot of people are just not aware, or they'll target certain people like elderly or something they don't know, and it's just an awful thing. So just something to be mindful of. Get that letter, and then you can follow up and at least bring it to the attention of your tax professional so that you can validate the legitimacy of them or not. Example number 2, what they're seeing as this is a probably a normal thing. Social media has taken over. It doesn't, you don't need to go too far where someone's promoting another tax strategy or way to reduce tax or how the wealthy are doing it. These sort of tax hacks that are growing all over the place, on TikTok, Instagram, you name it, and things that they're promoting. And unfortunately, a lot of them are coming at it with not great information or half truths or misinformation altogether. And they can be very dangerous if acted upon. And so you just have to be mindful. Yes, there might be ideas you might want to explore, right? But you definitely do not want to be taking those as absolute truths or accurate sort of interpretations of the tax code or law. You really need to take the time and effort and get the right expertise and help to validate them. One being, self-employment tax credit, and this was, done back in the days of COVID, and they were being promoted. You can get these tax credits as a self-employed person, but evidently the credits really applicable to very narrow situations, but they're trying to use them everywhere, and they're using social media and such to really draw attention and really get people interested in saying, "Hey, let me take advantage of these things." So there's a bunch of others like that, but obviously in the broader scope of things, like just be careful what you see on social media related to tax strategy, because it's happening more and more, and a lot of information is just not very good. And it could get you in a lot of serious trouble if you follow it based on what they describe. Third one, which I found interesting, is a ghost tax preparer. So these are who are not sort of licensed to actually prepare taxes, but they promote themselves to do it. They're obviously charging you a fee potentially and saying, "Hey, I can find you all these tax loopholes and deductions or whatever." And but then they never actually help you physically. They won't sign the tax return. They won't actually submit it for you, because they can't, right? And because they don't want to be held on the hook for anything, because they know that these will not hold up. So they're just trying to promise these things, charge a fee, and sort of if anything goes wrong with it, you're on the hook, right, as a taxpayer. And so they're trying to just pretend to be legit tax preparers, and and try to promise these sort of crazy tax reduction sort of strategies, but they're just fake, and they're not going to submit them for you, and they're going to leave you holding the bag as a taxpayer. So evidently that's happening more and more. So just be careful who you're working with for sure, and check your credentials, make sure they're able to properly prepare and submit your tax return on your behalf. Some tax strategists themselves don't actually do the return. So they should be working in concert with your tax professional who's filing, your CPA or enrolled agent. Have them working in conjunction together so that you can get anything that you're doing there properly reported and vetted by your tax professional. A fourth example is this surrounds different types of tax credits. So you hear tax credits, deductions are one thing, but tax credits are one-for-one sort of credits against your tax liability. And there are ones like improper fuel tax credit claims. And there's promoters who are trying to push this to a lot of people to to be able to take advantage of these fuel credits, which were really intended for a very distinct audience base of farmers, agricultural businesses, and off-road equipment. So it's a very narrow band, but they take the tax credit and try to apply it much more broadly for things that it was not intended for. So pushing ordinary taxpayers to take credits when they just don't qualify. So again, anything that is getting promoted in a way, it's something that you just need to validate it and ask the people who are suggesting these things, like, show me exactly how I actually qualify for this, and ensure that it passes the muster of a potential audit in the future. And so the IRS is seeing these come through quite a bit, and they're getting flagged. So it's important for you to know that, because they're looking for it. And again, this is why it's on the Dirty Dozen. And it's a good sort of lens to take anyway to make sure they're legitimate and that you apply for them and you can prove it if you ever get audited. Last example I'll share, and this is not probably a new one for many people, inflated charitable deductions. One of the big incentives within the tax code is charity. Whether, I donate to my local charity, I can, obviously get a write-off on that and apply that as a deduction against my income. And so unfortunately, there's a lot of promoters who are doing this to inflate assets and property and create a fair market value of them, quote unquote, for an excessive amount. That could be related to land or artwork and you name it. And they will inflate the appraisal of those assets so that when you go donate them, they're going to show up to be much higher. So, but if the appraisal isn't legit and, then it lacks any substance to it, and then that's where you start becoming a problem. And so there are things around like conservation easements, things of that nature, really draw attention to the government. So there are legitimate cases where this can make sense, and if done properly with the right type of partners. But obviously there are a lot of folks who are taking advantage of this to try to improve the deductions on them to boost those up inappropriately. So just need to be careful if you stumble across these or someone's showing these to you, that you really ask about that around the appraisal, how they're going about doing, how they justify it, and are they above board on how they're approaching it. Just definitely something to be looking into. Now, those are just some of the 30 dozen. You can go deeper in looking at them, and unfortunately there's that's only narrowed it down to a dozen. There are a bunch of others that may be flagged as potential issues. So again, now, and the IRS is not saying you don't do tax planning. They're encouraging it because the tax code actually does serve a purpose to incent certain things and economic sort of substance in activity. So, there is a benefit to tax planning because it supports a lot of what the government wants us to do if you're doing it in the right way. And that's what we're trying to promote here. Is tax planning is not just like you're doing planning for vacation or planning for your finances. Like, tax planning is encouraged, right? You just have to do it legitimately and be aware of these sort of scams or inappropriate uses of the tax code. But it could be very powerful if you understand them. And it comes down to three really key important areas from my lens. Is that when you're planning and anything you're engaging in doing, does it have any economic substance to it? If you're doing a business, you are investing in something, like, does that do any of the things that you're putting your money towards or approaches? Can you easily explain the economic substance behind it? Why are you doing it, right? To justify the sort of the tax planning. So it better have something legitimate to it. It can't just be for reducing taxes. Clearly, the second one is there's clear law that helps support it, right? That there's some code. Now, there might be some gray areas of interpretation. This is where you're going to leverage experts to help you interpret them, but at least having some semblance of law that helps support it would be number two. And the last one is that you're implementing them properly, right? There's some that get more complicated, some strategies, some approaches, and to ensure that you are following the law and can easily sort of defend it if ever audited is that there are certain things that have to be done and implemented to ensure that you adhere to the law and that you're following the rules set forth by IRS code. And so those are key important elements to it to make sure that you're following it and you're doing it to legitimately, and it can pass muster if you're ever audited because you're following what the IRS has put forth. So here's this is not any remotely exhaustive, but just to give you a flavor of the types of things, right, you can do that you may or may not know about, given your experience. And obviously, I'm sure a lot of you've heard that real estate it can be extremely tax advantaged, right? It's a unique asset class. It's funny how they call it alternative, right? Like real estate's been around forever. So one of those areas that comes up, which may be misunderstood, is depreciation. And it can come in all sorts of ways, but essentially what it is you're able to deduct the cost of that asset and how it will sort of deteriorate over time. You can take the cost of that earlier, right, over time. So without any unique things going on, they say it takes 27 and a half years, and you can take a chunk of that cost of that home or asset and apply it as a loss, right, against or cost against the income of that asset through depreciation. Even though you didn't actually incur an expense, it's going to look like an expense on the books because it's an asset that's losing value over time. And so there are ways to actually accelerate that, and that's through things like cost segregation, where you have engineers come in, you'll take a look at the building, and there's some things that could be actually depreciate faster than 27 and a half years, like lights and things that are disposable, carpets, things that are going to not last that long. So you can accelerate and depreciate that earlier, say in 5 years. And now, which was renewed again in the last update, bonus depreciation, where you can take some of those things, you can depreciate them even faster in year one, right away. And so there's a lot of emphasis around that in real estate. And in those cases, it's probably more in the world of short-term rentals and the cost segregation sort of approaches to accelerate those sort of costs upfront to go against any income you may have. And if done properly, if you're materially participating in these activities, a real estate professional, which we won't go into the heavy detail, there's a lot of costs that could go against active income, right? Even W-2, their job income. So those are unique things that can really accelerate the realization of those costs earlier, even though no money is going out of pocket. So that can now clearly reduce your income. And these are not, although there are certainly some complicated areas of it, this is in the code, and it's something that's been done for a while. It's not a new thing. But you just have to recognize, what's the economic sort of activity behind all of this, real estate, using for real estate investment, for your business. There's got to be a legitimate use of that. And then you just follow laws around how you can realize some of the costs like depreciation earlier than you may have thought. So a second strategy, legitimate one, clearly charity. We talked a little bit about that, where it can be abused quite a bit. To charitable planning, they want us to give to charity and support others and help the greater good. So there's a lot of ways you can take appreciated assets and donate them to reduce through your taxes, right? You have appreciated stock or real estate or something, and you may have a large capital gain in there that you don't want to realize if you sold it. You can donate that asset, right? There are ways to do that. And then that asset in its full value can be donated, and you can benefit with a donation deduction off your taxes. And then, there's no capital gain to be had there. So those are unique ways, and those can be coupled with, certain trusts that can be sort of created, like a charitable remainder trust and things of that nature, where you can support businesses after you die, that can go to charity after. So there's unique ways you can take appreciated assets and and do that and donate it and benefit now. And, in the end, the charities also win. The only one that doesn't win is maybe the IRS. They may lose out on taxes, but the charities will win for sure. And obviously you have things like donor advised funds where, you're donating money and, or appreciate assets. And, that's just over time, you can choose when to donate to whatever causes you want. And, you could take the large deduction up front and then give the donations out over time. You control that. So those are not really tax mitigation strategies in themselves because you basically are giving up that asset, but it's still something that could help you, reduce your taxes and serve your desire to actually give to charity as well. And so it's just the code is really intentionally sort of designed to encourage it. So it's something to definitely look into if you're charitably minded. And so the last sort of strategy, and again, this is not trying to cover everything out there, just to give you an idea, is around business structure. Obviously, there's a lot of tax benefits to spur business and hiring people and doing research and development, credits, things of that nature. But even something as an example of using as an S-Corp election in your LLC that could be created so that you have some limited liability associated with it, but you can also be the employee of your own business, right? And collect the salary legitimately. This is all written in the code, as long as you're taking a reasonable salary. And then, you can reduce your self-employment taxes on your overall income if structured properly and reported accurately every year. Obviously, you have unique retirement plan structures as business owners. You can put in way more into those accounts, like in your SEPs or solo 401ks. And, there are cash balance plans that you can put significant amount of dollars into qualified plans where you can take big deductions against your income from your business. So those things are available. And then obviously timing of income and expenses that, depending on what's happening, there are some options to delay them, defer income or expensive, or pull them in. So just some things to consider how you can pay your property tax up front and things of that nature to help sort of, position and time your income and expenses to best suit you and mitigate taxes. And so it's really helping you design sort of how you're operating in life and structuring your business. And so it's just some things to work through with a strategist and your a tax professional to see what might fit. So those are just some examples. And so what I'll want to leave in this podcast with is, and some of this is sort of just reiterating some of the key points, is what should you be asking about when you're thinking about tax strategy, right? One being is the economic substance. How do you justify what is it? What's the actual investment or business activity that's driving it? It cannot just be about saving taxes. That can't be the driving motivator, right? We can't have the tax tail wag dog sort of concept. So understanding what's the meat and potatoes around the activity that can spur a tax benefit in addition to it. Is there clear law or at least attorney review around the tax code that can be sort of referenced and reviewed tied to this sort of strategy or quote unquote loophole, right? So what justifies it? Where can you have proof to that? And, whether it's through a legal opinion letter or through your own CPA to be able to investigate these things to see if there's legitimate sort of rules around it, or at least interpretation of it that can support the strategies that the sponsors are recommending. And then lastly, this goes back to any of these things, getting the right minds together to look at it from different lenses, whether it be your CPA or enrolled agent to, your attorney, to your financial advisor. I think it's important to get that well-rounded sort of set of eyeballs on it to ensure that all the different sort of areas are sort of looked at, because they're going to bring their unique expertise into the fold to help analyze this thing from a economic substance perspective to the tax code to, the legal sort of arm to it to see where you're really at risk. So really helpful to get that team together to be able to assess these things and help you make, the best decision for yourself. So in closing, the tax planning, the goal really isn't, and you can do this, but it's not really to eliminate all the taxes you have, right? And all the costs, right? There might be opportunities to do so legitimately. But really, when I look at it, it's more about making smart decisions about how you're investing, growing your business, investing in your business, and lining all these things up with your broader long-term goals in life, right? The finances need to support what you're trying to drive to in life. Just saving money in taxes for no purpose or reason seems not overly useful. It's got to have a purpose, and that's exactly why we tie it into economic substance, and that should sort of be a good guide for you and help safeguard you from risk if you take that lens first, right, to see where it's supporting you, and then that tax angle can be supportive as a secondary piece of it. So hopefully this was helpful. Just gives you a lens. Certainly go digging into the Dirty Dozen, interesting stuff. And don't be scared of tax planning. Just know going into it to ask the right questions and take it from a logic around, does this make sense? And how can I prove it? And then you'll recognize whether it's a good fit for you or not based on what you're trying to achieve in your financial life and, more importantly, in your life in general. So thanks for joining me as always. And we'll see you on the next episode of the Perennial Pride Podcast.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride Podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life. And abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.